Welcome to Tax Smarts Unlocked, the podcast for individuals and small business owners looking to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services, each episode is packed with insightful advice on proactive tax planning to help you navigate the complexities of tax laws. Here's your host, David Robson.
Welcome to Tax Smarts Unlocked. I'm David Robson, your tax strategist, here to help you keep more of what you earn. Today, we're navigating tax season with practical tactics for individuals and small business owners. We'll hit quick checkups, timing moves, retirement and health accounts, small business power plays, real estate angles, red flags, and case studies you can use. Quick disclaimer, education, not advice. Ready to trade tax dread for after-tax cash flow? Dive in. Start with a 10-minute tax checkup. Estimate your year-to-date income, withholding, and quarterly payments. Know your safe harbors, generally 100% of last year's tax, 110% if AGI exceeded $150,000, or 90% of this year's. Hitting a safe harbor avoids underpayment penalties even if you owe in April. W-2 earners can adjust Form W-4. Owners can tweak Q4 estimates. If income is spiking, consider withholding on a late-year paycheck. It's treated as paid throughout the year. Next, time income and deductions to manage brackets and phase-outs. If you're near a cliff, think child tax credit, education credits, or 20% QBI deduction. Defer income or accelerate deductions. Deferral tools include delaying invoices, timing year-end bonuses, or postponing Roth conversions. Acceleration can mean prepaying state estimates, giving to charity, or making business purchases you need anyway. Always test ripple effects. AMT exposure, NIIT thresholds, and state tax interactions can turn a good move mediocre fast. Capital strategy isn't just loss harvesting. In low-income years, harvest long-term gains at the 0% bracket to raise basis with no tax. Coordinate with the 3.8% net investment income tax. It kicks in when AGI exceeds $200,000 single or $250,000 married filing jointly. If you're near those thresholds, deferring investment income or increasing retirement contributions can avoid NIIT. Loss harvesting still matters. Pair losers with gains, but watch wash sale rules and avoid nullifying dividend or credit eligibility. Tax-advantaged accounts are your cheat codes. Max workplace plans, 401k or 403b, and use catch-ups if you're 50 plus. Consider Roth versus pre-tax based on current and expected brackets. No plan, open a SEP IRA or solo 401k for self-employment income. Solo 401k wins for Roth and higher contributions. Don't miss HSAs for high-deductible health plans. Triple tax benefit. High earners can use backdoor Roth, minding pro rata rules. Sometimes a prior year IRA rollover to a 401k clears the path. With the higher standard deduction, folks should bunch itemized deductions into alternating years. Stack charitable gifts, medical expenses, and state taxes in one year, then take standard next year. A donor-advised fund lets you front-load years of giving, claim the deduction now, and grant later. Donating appreciated securities avoids capital gains. For those 71-2 or older, qualified charitable distributions from IRAs give a tax-free route. Remember the 10,000 SALT cap limit state and property taxes. Business owners, deduct what is ordinary and necessary. Implement an accountable plan to reimburse expenses paid personally, mileage, cell phone, home internet, avoiding taxable allowances. Home office? Use simplified or regular. Regular may yield more if you track costs. Vehicles. Choose standard mileage or actual, but be consistent and keep a mileage log. Meals are 50% deductible. Entertainment isn't. Substantiate travel. Who, what, where, when, why. Commingling funds and missing receipts shrink deductions quickly. And documentation matters. Depreciation can turbocharge deductions. Section 179 lets you expense eligible equipment up to the annual limit, constrained by taxable income. Bonus depreciation allows immediate write-off of qualifying assets, phasing down in law. Compare which mix fits cash flow and income. Listed property, like vehicles, requires documentation. Real estate investors can accelerate deductions using cost segregation to break out shorter life components. Coordinate with passive loss rules, recapture exposure, and state conformity so today's write-off doesn't become tomorrow's surprise. Choosing the right entity impacts taxes and payroll. S corporations can reduce self-employment tax by splitting owner pay between W-2 wages and distributions. The catch, Reasonable compensation is required for your role, industry, and profitability. Underpaying invites penalties. Payroll must be set up and run on schedule, with state and federal filings. Evaluate state taxes. Levy franchise or gross receipts taxes that offset savings. Partnerships and LLCs remain flexible. Don't chase labels. Run projections before switching structures. Let's unlock the QBI deduction. Many pass-through owners can deduct up to 20% of qualified profits, but it phases with income. Below thresholds, it's straightforward. Above, you may need W-2 wages or qualified property to compute the limit. Specified service trades, like health, law, consulting, face stricter phase-outs. Strategies include managing income, paying reasonable W-2 wages, and timing equipment purchases. Remember, QBI excludes reasonable comp, guaranteed payments, and investment income, so entity and payroll choices matter greatly. Hiring your kids can shift income to lower brackets and fund Roth IRAs with earned income. The work must be legitimate, documented, and paid at market rates. Under a sole proprietorship or disregarded LLC, wages to your under 18 child aren't subject to FICA. S-Corp and C-Corp must withhold normally. Run real payroll, timesheets, W-4, I-9, and year-end W-2. Watch the kiddie tax on unearned income. Earned wages are fine when substantiated and recorded. Real estate deductions hinge on passive versus non-passive status. Most rentals are passive, but material participation can make losses non-passive if you qualify as a real estate professional. Short-term rentals averaging 7 days or less can be non-passive with participation without the status. Keep logs. Evaluate cost segregation impacts. For homeowners, home sale exclusion can shield up to $250,000 single, $500,000 married of gain if you meet ownership and use tests. Watch partial exclusions for moves. Health accounts add stealth savings. HSAs offer triple tax benefits, deductible contributions, tax-free growth, and tax-free qualified withdrawals. Invest them if you can cover near-term costs from cash flow. FSAs are use it or lose it, but great for predictable expenses. Avoid overfunding. Self-employed, deduct health insurance premiums above the line, limited by profit. Small employers can use QECSHRA or ICRA to reimburse premiums tax-free with proper plan documents. Keep receipts and explanation of benefits to substantiate distributions properly. Estimated tax strategy should match your cash flow. Choose a safe harbor, 100% of last year's tax, 110% for higher AGI, or 90% of this year's, and set reminders for April, June, September, and January. Seasonal business, annualize income to align payments with profits. If you're behind late year, increase paycheck or retirement distribution withholding. Unlike estimates, withholding is treated as paid ratably all year. That move can neutralize penalties while preserving cash until year-end for upcoming liabilities. Bulletproof record keeping wins audits and saves time. Use separate business banking and a clean chart of accounts. Digitize receipts, note business purpose, attendees, and amounts. Keep mileage and home office logs contemporaneously. Reconcile monthly. For information reporting, collect W-9s before you pay vendors, then issue 1099 NEC or 1099 MISC as required. Don't forget rent and attorney payments. Stay tuned to evolving 1099K thresholds on payment apps, and download platform statements early. Books reveal tax planning opportunities. Let's bust red flags and myths. A money-losing activity without a profit motive risks hobby loss treatment, no deduction beyond income. Document intent, business plan, marketing, and time. Crypto and NFTs are taxable on sales, swaps, and spending. Track basis and Form 8949 details. Payment apps report more often. Income is taxable whether or not you get a 1099K. Big round numbers, weak logs, and personal expenses rebranded as business are audit bait. Substantiate or forfeit deductions. A winning cadence beats last-minute scrambles. Mid-year, project income, deductions, and credits. Adjust withholdings, estimates, and retirement contributions. In the fall, revisit entity choice, salary levels, and QBI levers. Time big purchases when they align with Section 179, bonus depreciation, and cash flow. Before year-end, reconcile books, chase W-9s, and clean up AR and AP. January is for 1099s, W-2s, and new W-4s. Schedule quarterly check-ins so surprises become choices, not emergencies for your goals. Quick case studies. 1. S-Corp owner paying herself little raises salary to reasonable, qualifies for 199A, and minimizes audit risk. 2. Family bunches, 5 years of giving into a donor-advised fund in a high-income year, itemizes once, then grants annually. 3. Freelancer opens solo 401k, shelters profit, and adds Roth bucket. 4. Retiree harvests 0% long-term gains, then Roth converts up to the bracket top. 5. Converts rental to short-term, materially participates, uses losses strategically. A seasoned tax pro often pays for themselves. We coordinate multi-state filings, AMT exposure, NIAT planning, equity compensation, and entity optimization. We translate IRS alphabet soup into practical steps, spot elections you didn't know exist, and run projections before you spend or sell. We also build substantiation systems, prepare information returns, and stand with you if questions arise. Importantly, we uncover proactive opportunities that software misses, so you keep more, sleep better, and grow faster. That's a wrap for navigating tax season. We covered quick checkups and safe harbors, timing income and deductions, capital strategies, retirement and health accounts, itemizing tactics, small business essentials, depreciation, entities, QBI, family payroll, real estate angles, estimates, record keeping, information reporting, red flags, planning cadence, case studies, plus why a pro pays for itself. If this saved you stress or dollars, subscribe and share. Need help? Reach out. I'm David Robson, and this is Tax Smarts Unlocked.
Thank you for joining us on Tax Smarts Unlocked, the ultimate podcast for individuals and small business owners ready to conquer the tax landscape with confidence. Hosted by seasoned tax professional David Robson of Premier Tax and Business Services. Each episode has been carefully crafted to provide you with insightful advice on proactive tax planning. By adopting a smarter tax approach, you can focus on what you do best, growing your wealth and your business. We're here to guide you every step of the way. Don't miss an episode. Subscribe to Tax Smarts Unlocked on your favorite podcast platform and unlock the secrets to confident tax planning. Remember, it's time to take control of your taxes and unleash your full financial potential.